The next big factor you should consider is the macroeconomy. The biggest wildcard this year compared to previous years is the serious risk we are heading into not only a recession, but a deep recession. Cryptocurrency investors have all benefited from the 13-year stock and asset bull market that have had few major downturns other than one sharp but brief downturn in 2020. Hence, investors have never seen cryptocurrencies go through a deep recessionary environment such as those in 2000 or 2008. So there could be greater downside risk. One can even argue that the Fed stimulus since 2008 has artificially magnified the gains of high-risk assets such as Bitcoin. If we go into a deep recession, the stock market may have another 50% to fall, and Bitcoin may fall even more than that. There are some leading indicators we can follow that may give us some early warning signs of a recession. The first indicator is when we have yield curve inversions, when long-term bond yields are lower than short-term bonds, and there is an expectation of an extended economic slowdown. This chart is the 10-year minus the 2-year chart. We see the red circles where inversions occur before recessions. Stock markets peak on average 10 months after an inversion, but the range is wide. Stock markets can peak much sooner or later after an inversion. We can also compare the 10-year yield to the 3-month Treasury yield. Stock markets peak on average 4 months after these kinds of inversions, but again may happen much sooner or much later. The housing market is an early indicator and is the main driver of the general business cycle. In the Great Financial Crisis, the housing market peaked in 2006, but the recession didn't start until 2 years later in 2008. We may be having a more rapid decline after coming down from the 2020 Fed liquidity injection, but cyclical housing data seems to be trending down, and new housing stats seem to suggest a longer-term downturn. Another early indicator to follow is continuing jobless claims. Deutsche Bank stated that when 4-week average continuing job loss claims move up 11.5% from a significant low point, a recession may begin in roughly about 2 months. The latest number was 1.438 million, and we are getting very close to reaching the 1.456 million threshold. We can monitor trends from the Economic Cycle Research Institute, ECRI, that rely on proprietary research of leading indicators. Their statistics show weakness in the economy and that we are at levels very close to previous recessions. However, recent data shows a small positive trend in the last couple weeks. Interestingly enough, in the last couple recessions, when the Fed actually started cutting interest rates, that was a sign of nearing a peak in the stock market. Hence, a rate cut or a pause might be thought of as bullish, but could be an indicator of a deeper recession. It's also good to monitor coincident indicators such as the ISM PMI Manufacturing Index to compare with past recessions to identify the potential magnitude of a recession. We can also monitor the main factors of the NBER, the organization that declares official recessions. They track non-farm employment, industrial production, real retail sales, real personal income. These currently have been trending positively but are lagging indicators. We should pay close attention to Fed monetary policy. Since the 2020 COVID lockdowns, the Fed injected nearly $4.5 trillion into the US economy by buying treasuries and mortgage-backed securities. Now they are in the process of quantitative tightening and selling treasuries, and there may not be enough buyers, leading to higher interest rates and headwinds in bond markets. Some suggest that QT could be the equivalent of raising interest rates by 1 to 3% or more. We can also monitor liquidity from Fed balance sheets, Treasury general account balances, and the repo market. Stock market earnings and valuations help us determine if stocks are cheap or expensive compared to the past. One simple method is to look at historical moving average trends in the market to see if markets are overvalued. We are 37% above the trend line based on this simple metric. We can also compare price to earnings ratios of companies in the S&P 500. It shows we are about 48% above the historical average. The Buffett indicator compares US stock market value to GDP. That shows we are about 37% above the historical average. We can compare stock market value relative to interest rates, and that indicator shows that stocks may be fairly valued. Interest rates are low historically, so low-yielding bonds don't seem to be that attractive relative to stocks, but rates are increasing. Currently, short-term bond yields after inflation are negative 5.85%, according to this chart from Pantera Capital. We compare that to historical average real rates of positive 2.63%. All this goes to show that stocks may be overvalued in general, but bonds that have negative yields are not an attractive alternative. So this year, both stocks and bonds have performed poorly, and bonds have not been able to soften the blow of the stock market downturn. In fact, bonds have had the worst returns in the last 45 years. Therefore, we may be heading for a long-term negative yield environment, or what we call a stagflationary environment, where inflation is higher than yields on bonds and where real earnings of stocks are depressed. That's what happened from the late 60s to the early 80s, where we had high inflation, high unemployment, low growth, and high interest rates. So what was the best asset to own in the stagflationary environment of the 60s and 70s? The star assets were gold and silver. People moved to safe havens to preserve their wealth from inflation, away from typical investments such as stocks, bonds, or real estate. From 1975 to 1980, gold went up 8x and silver went up 33 times. I expect that gold and silver will again be a star asset this time around, as well as Bitcoin. The cycles of real assets aren't just in stagflationary environments, but the last commodities boom was at the end of the dot-com boom in 2000, where gold rose 6 times from 2000 to a peak around the time of the Eurozone debt crisis in 2011. Overall, in stagflationary environments or real asset cycles, we can look at commodities, agriculture, and energy. Real assets and energy will be the focus this decade instead of technology. Lynn Alden, in her August newsletter, shows we may be beginning a cycle where value outperforms growth. This trend may capture the beginning of the real asset cycle. We are in a debt supercycle. In 2008, we had a mortgage debt crisis, and as the Fed propped up mortgages, some of the excesses spilled over to auto loans, student loans, and credit card debt. The auto loan bubble is popping, student loans are being subsidized and is unsustainable, and credit card debt may become a problem in a recession. The biggest debts are sovereign debt. The US federal debt is 133% of its GDP, and anything above 90% usually results in stagnation, likely stagflation or worse. But the US is not even the worst offender. A lot of easy money flowed into the corporate sector. Companies took advantage of financial strategies based on cheap debt and low interest rates. You can see corporate debt to GDP spiked in 2020 and has been trending up sharply the last decade. The problem? We now have more zombie companies whose interest coverage ratios are below 1, meaning companies may not have enough earnings to pay the interest on their debt. According to Credit Risk Monitor, 40% of public US companies fall into that category, and 31% of companies around the world. So we can see the negative impact of higher interest rates on companies, and credit contagion is a serious risk. We'll have to monitor CPI and inflation to see if the Fed can manage to minimize long-term inflation expectations. It seems CPI moves in cycles, and we should see a downturn, especially in the year-over-year stats, but the Fed typically will not stop until the Fed funds rate is above CPI, so that may not happen until the end of the first quarter next year. There is some risk of more supply side and energy inflation. There also might be a reevaluation of real assets based on the debasement of currencies via quantitative easing, so higher inflation may persist. We're having a global meltdown outside of the US. Europe has a severe energy and sovereign debt crisis and is heading towards third world nation status. China's real estate downturn is worse than the US crisis in 2008 and may lead to a banking crisis. Again, real estate is the main driver of all economic cycles, and so China is in deep economic trouble. China provided much of the low-cost labor and products to help the world out of recession since 2008. That's likely to slow down. Japan is known for creativity and inventions, but unfortunately that applies to their central bank that has been innovating on money printing and yield curve control. Japan has the worst sovereign debt crisis, with their internal debt at 250% of GDP, and the central bank owns over 50% of Japanese sovereign debt. And if you look at all the major central banks, they've created 22 trillion since 2008. And maybe that's why Bitcoin. Going back to real assets, over a decade ago, people were concerned about peak oil. That conversation might be coming back as people realize the US shale boom may have been artificially supported by cheap debt. So without enough cheap capital, shale oil may be harder to extract. We have to monitor the US dollar. The dollar is a safe haven when the global economy is melting down. When US Treasury yields go up and the Fed tightens, investor flows increase and the US dollar becomes stronger. There's over 13 trillion in dollar loans outside of the US, and with a stronger dollar, those loans become much more difficult to repay and creates demand for dollars compared to local currencies. This may lead to an emerging market crisis similar to the Asian crisis in the late 90s. Furthermore, when the global economy freezes, like in March 2020, there could be a dollar liquidity crisis, and it's another reason for the Fed to print money and buy bonds to stabilize markets as they did back then. The next area to monitor is geopolitics and war. Economics is one of the major reasons for war, but it's infrequently discussed. There are grand chess games being played, yet most people are only able to see the propaganda. We have dollar hegemony and oil priced in dollars. Many people and countries are reevaluating the value of real assets such as oil and natural gas compared to paper assets such as US and other sovereign debt. We have Russian sanctions and bank seizures and proxy wars against Russia. There are now increased collaborations between China, Russia, and India. We have tensions in Taiwan. Economic crisis can lead to both internal and external conflict, and governments would rather foment external conflict to distract from internal problems. There is a risk of World War III as we come to the last stages of the debt supercycle and sovereign debt crisis. Governments have always been the problem, but they'll blame it on a foreign enemy and make their people believe it was the fault of a foreign enemy and try to reset their economy and maintain power. The ultimate globalist solution is a world government. That's part of an even larger chess game being played out right now. I hope you found this video educational. If so, please hit the like and subscribe button for future updates on the micro, the macro, fundamentals, and some technical analysis for Bitcoin and crypto. Thank you and see you next time.